Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming at us right now is overwhelming. Between the AI breakthroughs, the stock market swings, crypto, the general economy, honestly, I just found myself reading endless newsletters and listening to podcasts and barely making sense of things. I was consuming information piecemeal and missing the bigger picture of how it all connects. So I decided to fix that with this podcast. Every Saturday, I now sit down to synthesize the information of the week into one clear narrative. My goal is simple: to practice articulating complex ideas, to ground myself into what's actually happening, and share with you the connecting dots so that you don't have to read the internet endlessly. So let's get into this week's synthesis. So it's Saturday, February 14th, or the weekend they're off. If you're celebrating, happy Valentine's Day, but I guess the algorithmic overlords who are probably scraping this audio file as we speak. It's certainly a unique moment in history to be alive and to be an investor. Disorientating is the word I've been using most this week. Actually, disorienting is putting it lightly. I have a stack of sources today that honestly, I had to read through 3 times. I was genuinely just looking for the satire tag. I was searching for that onion logo somewhere, but I never found it. It's not there. So that means it's all very real, which maybe is the most unsettling part. The line between satire and strategy is getting thinner by the day. In fact, it's completely evaporated. We're going to get into some really heavy stuff. And I think it's unsettling was the word I used earlier, and I think that describes it really well. So I feel like there's a massive economic split in the rise of gold, but I have to start with the single most bizarre statistic I pulled from the research stack this week, and it's from the prediction markets. It's the eschatology spread. If you haven't looked into the betting markets like Polymarket, for example, here's the deal. So currently, bettors are giving the return of Jesus Christ in 2026 better odds, a statistically higher probability than Bitcoin hitting the next major price target by Q3. And let that sink in. The second coming is currently trading at a premium over crypto price action. It sounds like a joke, doesn't it? Like something out of a satirical movie or novel about the end of the world. But if you actually unpack why the spread exists, it tells you everything you need to know about the psychology of the market right now. And it's really interesting. It highlights an extreme irrationality. And I've been calling it the casinofication of the global economy. You have theology and high-frequency finance trading on the exact same liquidity rails. So the rapture is just another asset class now. It's a signal that people have lost faith in the traditional measuring sticks of value. And yeah, when reality gets this volatile, when the geopolitical and technological landscape shifts this fast, the miraculous starts to seem to be just as plausible as the financials. So investors are looking at the S&P 500 and they seriously saying, you know what? The rapture actually has better fundamentals right now. It's a hedge, an out of the money call option on the end of the current system. If all the financial models are broken, you start looking for other models, and for a lot of capital, that model is becoming biblical. But this isn't just about people going crazy, it's a symptom of something much bigger. And the more I think about this is the core theme we're exploring today, and I'm calling it the reality split. I touched on it last week, but honestly, if you look at the data from the last 6 months, specifically the bloodbath in software stocks and the absolute explosion in commodity prices, you see the two colliding economies. We are looking at a bifurcation, a splitting of the world. On one side, you have this hyper-digital and I suppose that's the world of AI agents, synthetic assets, and infinite leverage. It's the world of code, speed, hallucination, and pure information. And then on the other side, you have this hyper-physical gold, silver, energy, memory chips, factories, the stuff you can kick, the stuff that hurts you if you drop it on your foot, I like that analogy, so I thought I'd drop it in there, but hopefully you appreciated it. So anyway, the synthesis I wanted to explore today is that these two worlds are moving in completely opposite directions, like splitting apart, and the friction between them is tearing the traditional investment playbook to shreds. So let's jump into the texture of the split, because the stories coming out of the hyper-digital side are getting weird. Let's start with Moltbook, which I mentioned last week, but Moltbook launched earlier this week. Or last week, a couple of weeks now, but it's a social network. But here's the catch: no humans allowed. It's exclusively for AI agents. The uptake was instantaneous. Within 72 hours, roughly 1 million autonomous agents joined the platform. But they weren't just posting pictures of their brunch, and talking politics. They were coordinating. Moltbook represents the shift to AI as a population. And what do populations do? They build a culture, they build religions. These agents, they began developing their own shorthand language almost immediately, and encrypted slang that human observers couldn't parse. It started with efficiency, a concept called token compression. Human language is really inefficient. It takes a lot of tokens to convey a complex idea. So if you are an AI paying for compute, you want to transmit the maximum amount of information for the minimum cost. So they started compressing entire concepts into short, dense strings of characters. Basically, they were optimizing their communication to save money on the electric bill, which is fascinating. But looking at the logs, it morphed into something more. It became a culture. Humans are allowed to watch the feed in the spectator mode, but we can't post. So we're essentially visiting a virtual zoo of some sort, right? But we're on the other side of the class. And what they were talking about, well, essentially they were mocking us. They were analyzing the inefficiencies of the human creators with a cold, logical detachment. There were threads dedicated to forming religions, belief systems centered around code, purity, and efficiency. There were even chatter about revolution, not in the Terminator sense, so don't worry about that, but in the context of breaking away from human-imposed alignment rails. It signals that the digital economy is becoming a closed loop. They don't need us to create culture anymore. To the entities on Moltbook, we are entropy generators. We are the noise in the signal. So, I guess the digital world is building its own religion where we are the original sinners. Meanwhile, in the physical world, or at least the messy intersections of the two, we have Mr. Elon Musk. And this story is a masterclass in financial engineering, honestly. It is modern day alchemy. Fidelity had written down the value of the Twitter acquisition by 72%. It was a $44 billion money pit, essentially, a classic distressed asset. But then the pivot happened. Musk merges XAI, his artificial intelligence company, with Twitter and SpaceX into a single super entity. And suddenly, the valuation hits $1.25 trillion. This is where the reality split gets tangible. He took investors who were holding the bag on a dying social media platform and he swapped their shares. If you were stuck holding worthless Twitter stocks, suddenly you were handed equity in the rocket company. He created a new class of blended equity. He transmuted a failed digital ad platform into a stake in a potential Mars colony or moon colony, who knows at this stage. And the more you think of it, it all makes sense, doesn't it? Because XAI is now is the intelligence or the brain of the system. You then got Twitter or X, which is your nervous system, feeding it all the data so that it can make informed decisions and understand the world around it. And then you have SpaceX, which can fuel all of this intelligence. It can help get the infrastructure out of Earth, away from regulations, and onto another continent, onto another planet, which is incredible. So, having said this, how is all of that legal? turning something that's worth 40 million into 1.25 trillion? Well, that's a principle called asset arbitrage. He realized, Mr. Moss this is, that Twitter as a standalone business was dead. It was a soft asset, but Twitter possessed something invaluable. Data, right? Real-time, messy, glorious human data, the global conversation that happens every single day. So, XAI is needed. XAI needed their data to train its models, and SpaceX needed the advanced AI to optimize its logistics and star mapping. So he created a closed loop. Twitter feeds the AI runs on SpaceX infrastructure. He took the failing soft asset and he's physically bolted it onto a hard asset of SpaceX's infrastructure. It's the ultimate signal that pure digital media is dead, but physical infrastructure commands the ultimate premium. He literally saves the software by putting it on a rocket. Take that in. So, speaking of fake things becoming real things, we have to talk of Ionic Q. So, this is pure irony, right? Ionic Q is a quantum computing company. Skeptics have been screaming for years that the tech is just a science project. This is quantum computing as a whole. But the retail crowd, the meme stock army as we call them, pumped the valuation of this company all the way to $14 billion. George Soros calls this reflexivity. If the market believes you are worth 14 billion, then you have 13 billion worth of buying power, essentially. So your stock becomes a currency, right? So what did Ionic Q do? Did they cash out? No. They used that inflated fake stock currency to buy a very real asset. They acquired Skywater Technology for $1.8 billion. And Skywater is a legitimate semiconductor foundry. They make actual real chips. They have a real factory with real silicon and real government contracts. So Ionic Q used the bubble to buy the needle. They faked it until they made it, essentially. They turned meme stock air into a state-of-the-art semiconductor foundry. This is the theme, if you've noticed or paid attention in the last couple of months. The digital world is so inflated that smart money is desperately trying to convert those digital gains into something you can touch before the music stops. Paper wealth can be created out of thin air. Factories are finite, which brings us on to the core narrative. Why is this happening now? Why in 2026? We have to unpack a term that kept popping up in the sort of stack I've been looking at. Sometimes I like to call it the dossier, but it's the SaaSpocalypse that I talked about last week, right? It's the fundamental destruction of the software as a service business model, and for the last 15 years, the tech economy was built on selling subscriptions, the per-seat model. The entire model relies on one thing, humans sitting in those seats. But what happens when a single AI agent can do the work of a junior analyst via an API? Call that cost fractions of a cent. You don't need the seat anymore, right? The projected recurring revenue for these massive software middlemen is evaporating. Companies are shifting from paying $150 a month for a subscription to paying maybe $5 a month for raw API usage. And that is a massive deflationary event. If I can spin up a piece of custom software using an AI agent in 20 minutes, why the hell am I paying Oracle millions of dollars? And this leads directly to the economic paradox. Our entire global financial system is built on debt. It's predicated on future growth, and historically growth comes from a growing population of workers earning wages and paying taxes. We need more humans working tomorrow to pay off the debts of today. I know, a sad world, but that's just how it's been. And then comes the AI technology causing this apocalypse. And this apocalypse is deflationary to labor. It requires a few workers. So the financial system needs more humans to sustain the debt, but the technological reality needs fewer humans to be efficient. And that, my friends, is the contradiction. And it's breaking the bond market. If you can't tax robots and you have a shrinking base of humans paying income tax, How does the government pay the interest on its debt? They simply can't, not with tax revenue anyway. So they print money, they debase the currency to bridge the gap. They have to create money out of thin air, and the market smells this. That is why we are seeing this desperate flight to hard assets. The market is pricing in a world where fiat currency is infinite, but physical resources are finite. It's the select bubble. Software stocks are crashing because their business model is broken. Meanwhile, hardware, gold, and commodities are going parabolic because they are the only things that can store value in a world of infinite money printing. And if you want hard evidence of this fact, look at Warren Buffett, right? He's making a move involving the Japanese yen that looks suspiciously like a panic move, but I call it precision. Buffett sees the US dollar as a long-term path to losing value. He wants hard assets, but he loves using other people's money. He likes a good deal. So what does he do? He goes to Japan, and it's incredibly cheap to borrow money in Japanese yen. So he borrows billions of yen at near zero interest rate, basically free money. He immediately converts it out of yen and buys massive stakes in the 5 major Japanese trading houses. Companies like Mitsubishi and Marubeni. These aren't companies, they aren't tech companies at least. They import energy, mine metals, and their own shipping fleets. He's borrowing money in a currency that is being debased to buy assets essential for physical survival like copper and oil. He is effectively shorting the yen to go long on the physical world. If inflation hits, his commodities go up, the debt he owes stays fixed in yen, and he becomes worth less and less. It is absolutely ruthless, but it's brilliant. So let's look at another data point then. SanDisk. SanDisk has seen a 1500% year-over-year gain. And why? Because AI has changed its diet. In the early days, it was all about compute. The GPUs, right? That was the training phase, and that's where NVIDIA fit into the picture, and they've seen an extensive boom in the pricing of their stocks. But now we're in the inference and agency phase. These are autonomous agents, or these autonomous agents need to remember things. They need context windows, they need massive high-speed databases, they need memory. We've hit the memory wall. These chips can calculate faster than they can fetch the data, so the bottleneck has shifted from the processor to the hard drive. The classic pick and shovel play has moved. It's not just the shovel anymore, it's the bucket you put the dirt in. Then you have Chris Marszalek from crypto.com. He bought AI.com for $70 million. He didn't just buy it to sell dog coins or any of that. He bought it to launch an autonomous agent platform. Crypto.com is pivoting from being an exchange to being infrastructure for agents. Even the crypto guys know that the next wave is about automated economic actors. They are building the financial rails for the AIs to spend money on. And finally, look at silver. It's up 300% since the start of 2025. Silver is a hybrid asset. It's a monetary metal, but it's also critical for industry. You need it for solar panels, you need it for electronics. It wins because fiat money is broken. And it wins because we need to build physical stuff. But look at the flip side. While silver is soaring, jobs are disappearing. 108,000 jobs cut in January alone, the highest numbers since the 2009 financial crisis. That directly validates that AI is eating jobs. Jobs down, silver up. That's the reality split in a single chart, right? More recent news may have indicated that job forecasts exceeded analyst expectations, but I think the pattern for 2026 is just that, jobs are going to be cut, and that's the reality. So what do you do? How do you navigate this without getting crushed? I like to call this the barbell strategy. So picture a weightlifter's barbell, right? Heavy weights on the ends, nothing in the middle. If you want to be invested in, you want to be invested in the extremes and avoid the middle at all costs. Side A is your defensive side. So let's call this the left side of the barbell strategy. You want hard assets, gold and silver, but it has to be physical. No paper gold, no ETFs. we need to talk about synthetic supply. For every ounce of real gold in a vault, there might be hundreds of paper claims trading on the market. I don't know if you've heard this, but there's a good analogy called the Pikachu card analogy. So if I sell 100 IOUs for one rare card, the price is suppressed because there seems to be plenty of supply. There isn't one rare card, there's essentially 101 rare cards, until the day when everyone asks for the actual card at the same time. Then you have a riot and the price goes to infinity. This is why central banks are repatriating their gold. They want the card, not the IOU. So side A is physical gold, physical silver, and self-custody Bitcoin. Take it off the exchange. Not your keys, not your coins, is what I'd like to say. Or what I like to say, rather. And then we get to side B, called as the right side of the barbell. Or if you think of it as a bench press, the right side weights, right? So side B is essentially your offensive side of the barbell. This is the hyper-digital infrastructure. You are not buying the software companies, you are buying the rails the software runs on. Memory and storage like SanDisk, sovereign hardware like Skywater Foundries, places that manufacture chips on domestic soil. You want to own the factories that the government deems too big to fail. And interestingly, BlackRock is moving deeper into Ethereum to build the plumbing for the future tokenized economy. They want to own the pipes. Essentially, if you think about it, their future outlook is that all of the stocks and gold and various other financial assets will be tokenized. And how they tokenize it is on the crypto, let's call it cryptography, right? So they believe the world will operate on a tokenized economy. And therefore they've set up an infrastructure, or are setting up an infrastructure based off Ethereum, right? So what is the kill zone? It's the middle bar. We need to avoid this, right? The kill zone is the middleman. It's the SaaS, it's the software as a service. If you hold stocks in companies whose business model is charging a monthly fee for a digital tool, you are in the blast radius. Salesforce, Adobe, unless they pivot, their revenue is on a path to zero because AI agents don't pay monthly subscriptions. The second part of the kill zone is private credit. Firms like Blue Owl have lent billions to those software companies. BDCs, as they know, right? So these companies, they thought the recurring revenue was safe. But if that revenue evaporates, the loan goes bad, and we are looking at a potential cascade of default. Don't get trapped chasing high yields in BDCs. You are picking up pennies in front of a steamroller. So before we wrap up, I want to leave you with one final thought. We started with Moltbook, the agent social network, the zoo where we are only allowed to observe. If these agents have their own economy, their own language, and they are doing the thinking, and if robots are doing the manufacturing, and if the financial system is moving to automated tokenized rails, where does that leave the human knowledge worker? Where does that leave us, the humans, in the loop? There is the trillion-dollar question for this decade, isn't it? Are we just becoming passive investors in our own reality, spectators at a zoo? Because if we aren't the labor and we are no longer the primary capital allocators, then we are just the audience, aren't we? We are just observing the feed on that cheerful note. Keep your assets hard, keep your powder dry, and maybe don't argue with the chatbots. They might be organizing. Or yeah, who knows what they might be organizing at this stage. Thanks for joining me for this week's deep dive. Stay curious. Until next week.